Hello, this is Claire. This session we are going to talk about account rules and transaction analysis. Accounts are used to record any changes to an item. These are such as bank, land, capital, equipment, loans, accounts payable, accounts receivable. These are very common accounts used to record financial events. But there are more. An account is a summary of changes to an item. So sometimes in the textbook, you might find it to be abbreviated as A/C. That's acceptable. Accounts are categorized into either assets, liabilities, owner's equity, revenue, or expense. An account can either increase or decrease depending on the financial activity. It is essential to learn the nature of accounts. The orange color column indicates the nature of accounts, and there are 5 categories of accounts. So, to learn this, probably it's easier to follow this rule statement. It says to increase an account is to do the same as its nature, and to decrease an account is to do the opposite to its nature. So, for example, bank is an asset account, and the nature of asset is debit. So to increase the bank account, we would debit the bank account, and if we want to decrease the bank account, we would credit. This is accounting language. The debits and credit. I'll give you another example. For example, loan. Loan is a liability account, and according to this rule here, liability has a credit nature. So to increase a loan account is to credit the account, and to decrease the loan account is to debit the account. Now, following from the debit and credit, the double entry principle states that in any transaction record, the total debits must equal to the total credits. The double entry principle is a logical link with the accounting equation. Assets equals to liabilities plus owner's equity. If assets has a debit nature, and liabilities and owner's equity have a credit nature, then if we put this together, debits equals to credit. This is a checking device. Okay, so if your transaction is recorded correctly, the debit must equal to the credit. All transactions must be analyzed before they can be entered into any accounting books. Now we can complete a transaction analysis table to do this. This is an example of a transaction analysis table. It's got about 6 columns there, and with date, accounts involved. You have to indicate whether that accounts increase or decrease, what account type, and determine whether we debit or credit that account according to the accounting rule. And double entry principle. Here are some steps. Step 1 is to decide what 2 accounts are affected by the transaction. There must be at least 2 accounts. There could be more than 2 accounts. For example, 1st of July, owner contributed 50,000 cash as his capital. So, if the owner contributes to the business, then we will use the capital account to record this activity. And also, owner is contributing cash, so cash at bank is going to increase. So we will use the cash at bank account. We move on to step 2 to decide if the account is to increase or decrease. The capital will increase, okay, because the value of the business increases as the owner contributes into the business. And the cash at bank increases because the money is going to be placed in the bank. Step 3, we need to classify the accounts into assets, liabilities, owner's equity, revenue, or expense. We use the account rules to determine if the account should be debit or credit. So capital is an owner's equity account. To increase the capital account is to credit the account. Cash at bank is an asset account. An asset account has a debit nature. So to increase the cash at bank is to debit the account. And of course, we then present this information into the transaction analysis table. So we will present the date, and you only have to write that once for each transaction. Okay, and bank is involved. Increase the bank as an asset is to debit the account, so we write the 50,000 under the debit side. To increase the capital account as an owner's equity, we will credit this account, so we will write the 50,000 under the credit side. Here is another example. On the 3rd of July, we bought equipment and paid cash, $2,000. Now, paid cash, immediately that tells us there is a spending of money from the bank. So the bank is going to decrease in value. So therefore, we are going to credit this account, the opposite to its nature. And equipment is going to increase, so we will debit the equipment account. On the 3rd of July here, equipment increase, asset, $2,000 is going to be written under the debit side. And the bank decrease as an asset, so therefore we will credit $2,000. We'll write $2,000 under the credit column for the bank. Before we move on, okay, you must always check that you have applied the double entry principle. Debit equals to credit. Okay, so debit 2,000 equals to credit 2,000. So that's correct. So you rule a line across before you enter the next transaction. Here is another example, different one, because we are dealing with more than 2 accounts. Okay, so it's an opening entry. So in a new business, the owner sometimes contributes many assets, and we will list these assets according to their nature and work out the capital amount, because that's the value of the business. So on the 1st of July, the owner contributes cash 3,000, motor vehicle 6,000, and furniture 4,000. You simply list the assets accounts accordingly and write the value on the debit side because it's according to the nature of asset. Then you need to work out the capital value. Now we can use the accounting equation to work this out. Capital is under the owner's equity. So capital equals to asset consisting of bank 3,000 plus motor vehicle 6,000 plus furniture 4,000 and minus 0 liability, as it's there is no liability mentioned in the transaction detail. So we can work out here that the capital equals to 13,000. So this is we credit the capital at 13,000. The double entry principle has been applied here. Here's another example, and we have liability here. Okay, so if an owner buys an existing business, okay, so again we need to list these assets and liabilities according to their nature. Okay, then we need to work out the capital amount according to the accounting equation. So 1st of July, Bob buys an existing business with the following assets and liabilities. Okay, apparently we only have one liability. Looks like we've got the bank 3,000, motor vehicle 6,000. Okay, they both belong to the asset, and then we've got the loan of $4,000. So list them down according to its nature. Okay, so we've got the asset and the liability. Then we need to work out the capital. To work out the capital is simply following again the accounting equation. Owner's equity equals to asset minus liability. Your asset includes bank and motor vehicle. Okay, so that total is 9,000 minus your loan of 4,000. So that leaves you with $5,000 capital. So that's 5,000 credit. Under the credit column, we will write in the $5,000 for the capital. Okay, so far we have looked at how to write our transaction into the transaction analysis table. I hope this helped. You will need a lot of practice. Good luck. Thank you for watching the video.